Something shifted in the silver market last week. Not the kind of shift that makes headlines, not the kind that sends retail traders scrambling to social media for answers, but the kind of shift that seasoned investors recognize as potentially significant. Silver dropped 11% in a matter of days. For some, that triggered panic. For others, it triggered questions. And for a smaller group, those who've studied market cycles and understand how wealth is actually built, it triggered something else entirely, a quiet sense of focus. If you're watching this video, you're likely in one of two camps. Either you already hold silver and you're wondering if you made a mistake, or you've been watching from the sidelines, waiting for the right moment to enter. Both positions are legitimate. Both deserve clear thinking. What you won't get here is hype. You won't get predictions disguised as certainty. What you will get is context, historical perspective, and the kind of clear analysis that helps you make informed decisions rather than emotional reactions. Because here's what matters right now. We're not just talking about a single asset dropping in price. We're talking about a moment that reflects larger forces in motion, forces that have been building for years, forces that don't care about short-term price action, but that will ultimately determine where value flows in the years ahead. Let's talk about what's really happening. And more importantly, let's talk about what it means for you. To understand this moment, you need to understand where we've been. Silver hasn't moved in isolation. It's part of a broader precious metals market that has been responding to macroeconomic conditions that most people barely notice until they show up in their daily lives. Over the past 4 years, we've witnessed debt expansion on a scale that would have seemed impossible a generation ago. Central banks have navigated policy decisions with consequences that play out over decades, not quarters. Currency markets have shown stress signals that historically precede major shifts in purchasing power. Silver itself had been climbing, not dramatically, not in a way that caught mainstream attention, but steadily enough that anyone paying attention could see momentum building. From a low base in 2020, it had recovered and stabilized. Then, in recent months, it began testing resistance levels that matter to institutional traders. And then came the correction, 11% in days. Not unusual by historical standards for silver, which tends to be more volatile than gold, but enough to shake confidence among newer investors, enough to trigger margin calls for those who'd over-leveraged, enough to create the exact kind of psychological pressure that separates long-term thinkers from short-term reactors. Here's what didn't change. The underlying reasons people were interested in silver in the first place. The industrial demand that makes silver different from gold, the supply constraints that have been developing for years, the role precious metals play when confidence in paper assets begins to waver. The price changed, the fundamentals didn't. That gap between price and fundamentals is where opportunities emerge, but only for those who understand what they're looking at. Most investors make the same mistake when they see a sharp price drop. They interpret it as a signal. They assume the market is telling them something definitive, that the asset is broken, that they missed something crucial, that everyone else knows something they don't. But markets don't communicate in clear sentences. They communicate in price action that reflects thousands of competing interests, timeframes, and motivations. A hedge fund unwinding a position looks the same on a chart as fundamental deterioration. Profit-taking looks the same as loss of confidence. Technical selling looks the same as informed selling. The truth is more nuanced and less dramatic than most people want to accept. Price drops like this are normal. Not common, but normal. They're part of how markets breathe, part of how overextended positions get flushed out, part of how assets transition from weak hands to strong hands. Think about what actually happened here. Silver had run up. Not to bubble levels, not to levels that suggested mania, but enough that traders who'd bought lower were sitting on profits, enough that technical indicators were showing overbought conditions, enough that a catalyst, any catalyst, could trigger selling. That catalyst came in the form of dollar strength and some profit-taking in the broader commodities complex. Nothing revolutionary, nothing that changed the long-term case for silver, but enough to start a cascade of selling that fed on itself as stop losses got hit and algorithms kicked in. This is market mechanics, not market message. It's price discovery in action. It's the natural volatility that comes with any asset that isn't manipulated by central bank policy. And for those who understand this, it's not a crisis. It's information. The misunderstanding comes from treating markets as if they're always rational, always forward-looking, always pricing in all available information perfectly. But markets are made of people. And people respond to fear and greed on timescales that have nothing to do with long-term value. Let's step back and look at the landscape that makes silver relevant in the first place. Because if you don't understand the bigger picture, short-term price action will always control your emotions instead of informing your decisions. We're living through a period of debt expansion that has no historical parallel, not just in the United States, but globally. Governments have spent beyond their means for decades, but the pace has accelerated dramatically since 2008, then accelerated again during the pandemic, and now continues as structural deficits become the accepted norm. This debt doesn't disappear. It gets serviced through some combination of economic growth, taxation, or monetary expansion. When growth can't keep pace and taxation reaches political limits, that leaves monetary expansion, which is a technical term for creating more currency units, which is a technical term for diluting purchasing power. You felt this. Everyone has. The cost of basics, food, energy, housing, healthcare, has risen faster than official inflation metrics suggest. That's not conspiracy, that's math. When the money supply expands faster than the supply of goods and services, each unit of currency buys less. This is where precious metals become relevant, not because they're magic, not because they generate cash flow or dividends, but because they're finite, because they can't be printed, because they've served as stores of value across different monetary systems and different eras, precisely because their supply can't be manipulated at will. Silver sits in an interesting position within this dynamic. It's both a monetary metal and an industrial metal. It's used in solar panels, electronics, medical applications, and industrial processes. That dual nature means it responds to both investment demand and real-world manufacturing demand. And here's what matters. Industrial demand for silver has been growing, while mining supply has remained relatively flat. New discoveries are expensive to develop. Existing mines are maturing. The easy silver has been found. This creates a supply-demand dynamic that would matter even without the monetary considerations. Interest rates play into this as well. When rates are low, holding assets that don't generate yield becomes more attractive. When rates rise, as they have over the past few years, precious metals face headwinds because they're competing with yield-bearing alternatives. But rates can't stay elevated forever when debt levels are this high. The math doesn't work. Eventually, something has to give. Currency pressure is another factor most people underestimate. The dollar's strength or weakness relative to other currencies affects how international buyers view dollar-denominated commodities, like silver. A strong dollar makes silver more expensive in other currencies, which can temporarily dampen demand. But structural dollar weakness, which many analysts see as inevitable over longer time frames given fiscal trajectories, creates the opposite dynamic. None of this means silver goes straight up. None of this guarantees returns. What it means is that the fundamental case for owning some precious metals as part of a diversified portfolio remains intact. And when that fundamental case meets a sharp price correction, thoughtful investors pay attention. History doesn't repeat, but it does rhyme. And if you study how precious metals have behaved during previous periods of monetary stress, currency debasement, and debt expansion, patterns emerge. Silver is notoriously volatile, far more volatile than gold. During bull markets in precious metals, silver tends to outperform gold dramatically, but during corrections, it also falls harder. This is partly due to its smaller market size, partly due to its industrial component, and partly due to the psychology of traders who view it as a leveraged play on precious metals in general. Look back to the 1970s. Silver moved from around $1 to over $50 during that decade, but the path wasn't smooth. There were corrections of 20, 30, even 40% along the way. Investors who bought at the wrong time and sold during the corrections lost money. Investors who understood the broader trend and accumulated during weakness built significant wealth. The same pattern played out in the 2000s. Silver bottomed around $4 in the early 2000s and eventually topped near $50 again in 2011. But that decade included a massive correction in 2008 when silver briefly dropped 60% during the financial crisis deleveraging. Those who panicked and sold into that crash missed the subsequent rally to all-time highs. The pattern is consistent. During periods where monetary credibility comes into question, precious metals enter long-term bull markets. But within those bull markets, violent corrections are normal. They shake out weak hands, they flush out leverage, they create the exact psychological conditions that make people sell at the worst possible times. What's happening now looks familiar to those who've studied these cycles. We're in a period where debt levels are unsustainable, where monetary policy is caught between fighting inflation and supporting debt service, where currency debasement is policy rather than exception. These are the conditions that historically favor precious metals over longer time frames. But that doesn't mean linear price appreciation. It means a multi-year trend with significant volatility along the way. It means periods like now, where short-term price action contradicts the longer-term thesis and tests investor resolve. The investors who build wealth in environments like this aren't the ones who time every move perfectly. They're the ones who understand the broader cycle, who accumulate quality assets when others are fearful, and who have the patience to hold through volatility that would shake most people out. If you already own silver, you're likely asking yourself some hard questions right now. Did I make a mistake? Should I cut my losses? Am I falling for a narrative that's already falling apart? These are natural questions. They're often the wrong questions. The right questions are, has the reason I bought silver changed? Is my position size still appropriate? Am I emotionally capable of handling the volatility inherent in this asset? If you bought silver as a speculation, hoping for quick gains, then an 11% drop probably feels devastating. And that's information. It tells you your position size was wrong for your risk tolerance. It tells you your time frame was misaligned with the asset's nature. But if you bought silver as a long-term holding, as a form of insurance against monetary instability, as a component of a diversified portfolio, then this drop is noise. It's not pleasant. But it doesn't change the underlying thesis unless something fundamental has shifted. Ask yourself, are governments suddenly running surpluses? Has the debt been paid down? Have central banks found a way to unwind their balance sheets without market disruption? Is currency debasement no longer policy? Has industrial demand for silver collapsed? If the answer to these questions is no, and it is no, then what has changed is only price. And price, in the short term, is determined by market mechanics and trader sentiment, not by fundamental value. This doesn't mean hold blindly. It means evaluate rationally. If you're overleveraged, if you can't sleep at night, if this position represents money you need in the near term, then reduce your exposure to a level that allows you to think clearly. But don't confuse emotional discomfort with analytical insight. The best investors treat moments like this as stress tests. Not stress tests of the asset, but stress tests of their own decision-making process and emotional resilience. If you're panicking over an 11% drop in a volatile asset, you've learned something valuable about your risk tolerance. Use that information to adjust your position, not to abandon a sound long-term thesis. If you've been watching silver from the sidelines, this drop creates a different set of considerations. The asset is now 11% cheaper than it was days ago. Does that make it a better opportunity or a falling knife? The answer depends entirely on your time frame and your understanding of what you're buying. If you're looking for a trade for something that might bounce quickly, you're engaging in speculation. That's not inherently wrong, but understand that's what it is. You're betting on sentiment and technical levels, not on fundamental value. But if you're thinking in years, not weeks, this becomes more interesting. Not because the bottom is in, not because prices can't go lower, but because you're now getting exposure at a more favorable entry point than those who bought at higher prices. Here's what matters. Buying assets when they're falling feels terrible. Every instinct tells you to wait, to see if it goes lower, to wait for confirmation that the bottom is in. But by the time you have that confirmation, prices have usually recovered significantly. The best opportunities feel uncomfortable in the moment. This doesn't mean rush in tomorrow morning. It doesn't mean deploy all available capital at once. It means start paying attention, start doing your research, start understanding the asset, its volatility, its role in a portfolio, and whether it aligns with your long-term financial goals. Consider a disciplined approach. Maybe you allocate a small percentage of your portfolio to precious metals as insurance, not as a speculation, not as a get-rich-quick scheme, but as a hedge against scenarios where paper assets underperform, where currency purchasing power erodes, where traditional portfolio construction faces challenges. If you're going to enter, do it with a plan. Decide in advance what percentage of your portfolio this represents. Decide what additional price drops would mean. Would you add to the position, or have you sized it appropriately from the start? Decide what would make you sell. Not a price target, but a change in fundamentals or your personal situation. The worst way to enter any position is emotionally. Either rushing in because you're excited by a drop, or rushing in because you're afraid of missing the bottom. The best way is methodically, with clear thinking, with position sizing that lets you sleep at night regardless of short-term volatility. And understand this. If you buy silver today and it drops another 10% tomorrow, that's not a failure of analysis. That's markets being markets. What matters is whether the long-term thesis remains intact and whether your position size allows you to hold through that volatility without panicking. Let's talk about something most finance videos skip over, the psychological dimension of investing. Because all the analysis in the world means nothing if you can't control your emotions when prices move against you. Markets are designed to inflict maximum psychological pain. That's not hyperbole, it's structure. Assets tend to bottom when pessimism is highest, when everyone who could sell has sold, when sentiment is darkest. They tend to top when optimism is highest, when everyone who could buy has bought, when sentiment is euphoric. This means that good decisions often feel terrible in the moment. Buying during corrections feels like catching a falling knife. Holding through volatility feels like watching your wealth evaporate. Selling during euphoria feels like missing out on more gains. The investors who build real wealth over time are the ones who've trained themselves to separate emotion from analysis. They feel the fear. They feel the greed. But they don't act on those feelings. They act on predetermined plans, on risk management rules, on long-term thinking that doesn't change based on weekly price action. This is where most people fail, not because they lack intelligence, not because they can't understand financial concepts, but because they can't control their emotional responses to short-term market movements. Think about what an 11% drop triggers psychologically. Loss aversion kicks in. The pain of losing feels roughly twice as intense as the pleasure of gaining. Your brain starts looking for explanations. for narratives that justify selling to stop the pain. You start noticing every negative comment, every bearish analysis, every piece of information that confirms your growing fear. This is normal. This is human. But this is also what separates average returns from exceptional returns over time, the ability to recognize these psychological patterns and not be controlled by them. Discipline looks different for different people. For some, it means having rules written down that they refer to when emotions are high. For others, it means surrounding themselves with clear thinking advisors or communities that can provide perspective. For still others, it means simply understanding their own emotional patterns well enough to recognize when they're making decisions from fear or greed rather than analysis. What's universal is this. If you're making financial decisions based on how you feel about recent price action, you're reacting, not investing. And reactive investors consistently underperform patient investors over long time frames. This doesn't mean ignore your emotions. It means use them as information. If you're panicking, that tells you something about your position size. If you're euphoric, that tells you something about your potential overexposure. Your emotions are a feedback mechanism, not a decision-making tool. Let's be explicit about the mistakes that destroy wealth during periods like this, because knowing what not to do is often more valuable than knowing what to do. Don't panic, sell. This seems obvious, but it's the most common wealth-destroying behavior in markets. Selling after a significant drop locks in your losses and removes your ability to participate in any recovery. If you're going to sell, do it based on predetermined risk management rules, not based on fear. Don't double down blindly. The opposite mistake is equally dangerous. Just because silver dropped doesn't automatically make it a better buy. If your original analysis was flawed, if the fundamentals have changed, if you didn't understand what you bought in the first place, then adding to a losing position is throwing good money after bad. Add to positions from strength and strategy, not from hope that averaging down will save you. Don't use leverage. This is critical. Leverage magnifies both gains and losses, but more importantly, it magnifies the psychological pressure you feel during volatility. Investors using margin or futures contracts face liquidation risk during drops like this. They're forced to sell at the worst possible times because brokers demand it. Forced selling is the enemy of wealth building. Only invest capital you can afford to hold through volatility. Don't follow social media hype. Right now you'll find two camps online. Those saying silver is about to explode higher and those saying it's collapsing. Both are probably wrong. Both are definitely unhelpful. Social media rewards extreme views and confident predictions, not nuanced analysis. Your decisions should be based on your research, your financial situation, and your long-term goals, not on someone's Twitter thread or Reddit post. Don't mistake volatility for invalidation. A drop doesn't mean the thesis was wrong. It means markets are volatile. If you can't separate short-term price action from long-term fundamentals, you're going to make expensive mistakes. Learn to live with uncertainty. Learn to hold quality assets through volatility. This skill is worth more than any single investment decision. Don't ignore your overall portfolio. Silver is just one asset. It should represent an appropriate portion of a diversified portfolio, not the entirety of your wealth. If you've become too concentrated in precious metals, use this moment to evaluate whether rebalancing makes sense. Diversification isn't about maximizing returns. It's about surviving the inevitable periods when your best ideas temporarily underperform. And perhaps most importantly, don't make decisions while emotional. If you're angry, fearful, or euphoric, step back. Wait 24 hours. Write down your reasoning. See if it still makes sense when your heart rate is back to normal. The market will still be there tomorrow. But impulsive decisions made during emotional extremes rarely look wise in retrospect. So where does this leave us? What's the actual takeaway for someone trying to navigate this situation with clarity and discipline? First, understand that you're not making a decision about silver. You're making a decision about how you respond to volatility, uncertainty, and market cycles. The skill you develop here applies to every investment decision you'll ever make. Learning to think clearly during moments like this is the real value. Second, recognize that major opportunities are always born from discomfort. When an asset drops sharply and everyone's questioning whether it was ever a good idea, that's often when the risk-reward becomes most favorable. Not always, not guaranteed, but often enough that it's worth paying attention when others are panicking. Third, accept that you won't time this perfectly. You won't buy at the exact bottom. You won't sell at the exact top. Perfection is not the goal. The goal is making sound decisions based on solid analysis, maintaining appropriate position sizes, and having the patience to let long-term trends play out. Think in terms of probability, not certainty. Is it probable that governments will continue deficit spending? Yes. Is it probable that central banks will continue creating currency to manage debt? Yes. Is it probable that this creates long-term pressure on currency purchasing power? Yes. Is it probable that precious metals benefit in that environment? History suggests yes. But probable is not certain. And even when something is probable, the path is never straight. There will be corrections. There will be periods of doubt. There will be moments when it feels like you got it wrong. This is where character matters more than intelligence, where discipline matters more than analysis, where patience matters more than prediction. The investors who succeed over decades are the ones who can stay rational when others panic, who can maintain perspective when short-term moves would shake most people out. Consider this drop an opportunity, not necessarily to buy, but to learn, to observe your own reactions, to test your assumptions, to refine your understanding of how you respond to market stress. This information is valuable regardless of what silver does next. And think about time frames. If you're measuring success in weeks or months, precious metals will consistently frustrate you. But if you're thinking in years or decades, if you understand these assets as long-term holdings rather than short-term trades, then volatility becomes less relevant. It becomes the price you pay for asymmetric upside potential. Let's zoom out even further. Because silver's recent drop isn't really about silver. It's about how wealth preservation works during periods of monetary transition and economic uncertainty. We're living through a time when traditional portfolio construction faces challenges that didn't exist for previous generations. A time when 60-40 stock bond portfolios face simultaneous risk because both assets can decline when monetary policy changes. A time when currency debasement is policy, not error. A time when debt levels require increasingly creative solutions that all involve some form of value transfer from savers to debtors. In this environment, some exposure to assets that sit outside the traditional financial system makes sense for many investors, not as speculation, not as a bet against the system, but as prudent diversification against scenarios that monetary authorities may struggle to control. Silver sits in an interesting position within this framework. It's more accessible than gold for many investors. It has industrial applications that create real-world demand beyond investment demand. It's historically undervalued relative to gold by some measures. And it offers more volatility, which means more risk, but also more potential upside for those who can stomach the ride. None of this means you should rush out and buy silver tomorrow. What it means is that if you're going to own precious metals as part of a long-term strategy, you need to understand them. Understand their volatility, understand their role, understand why you own them, and what would change that thesis. The investors who get hurt during periods like this are the ones who didn't really understand what they bought, who got caught up in hype, who bought at the top because everyone was talking about it, who sized positions based on potential gains rather than potential losses. The investors who build wealth are the ones who did the work, who understood the asset, who bought with a plan, who sized appropriately, and who have the emotional stability to hold through volatility that shakes others out. This is the opportunity cost of volatility. Yes, seeing an asset drop 11% is uncomfortable, but that discomfort is the price of admission for assets that offer asymmetric return potential. If you want only assets that go up smoothly, you're limited to treasuries and money markets. And in an environment of currency debasement, those smooth rides come with their own costs. So what's the answer to the question in the title? Is this $1 million entry point? Could this correction represent a significant opportunity? The honest answer is maybe. It depends on your time frame, your risk tolerance, your overall portfolio construction, and most importantly, on whether you've done the work to understand what you're buying and why. What's certain is this: moments of clarity emerge during market stress. You learn whether your analysis was sound or hopeful. You learn whether your position sizing was appropriate or excessive. You learn whether you have the emotional discipline to be a long-term investor or whether you're really a short-term trader who didn't know it yet. These lessons are valuable regardless of what happens to silver's price in the coming months, because the same patterns repeat across different assets and different cycles. The ability to think clearly during uncertainty, to separate signal from noise, to make decisions based on probability rather than emotion. These skills compound over time. If you hold silver, use this as a moment to evaluate your thesis, your position size, and your emotional state. If everything still makes sense and you can hold through volatility, then hold. If something feels wrong, if you're losing sleep, if this wasn't really part of a long-term plan, then adjust. But do it from analysis, not panic. If you don't hold silver but you've been interested, use this as a moment to do research, not to chase a falling asset, but to understand it, to see if it fits your long-term financial goals, to determine appropriate position sizing, to create a plan for how you'd respond to further drops or sharp rallies. And regardless of where you stand, recognize that the most important work you do as an investor isn't finding the perfect entry point. It's building the knowledge and discipline that lets you make sound decisions consistently over time. It's developing the patience to let quality assets work for you over years and decades, not days and weeks. Markets will continue to be volatile. Assets will continue to move in ways that challenge your assumptions. Economic conditions will continue to create uncertainty. These are constants. What separates successful long-term investors from everyone else is how they respond to these constants. Stay informed, stay disciplined, Stay focused on long-term fundamentals rather than short-term price action. And remember that building wealth is a marathon, not a sprint. The investors who win are the ones still standing after everyone else has been shaken out by volatility they weren't prepared for. This moment matters, not because it determines silver's future, but because it determines whether you have the clarity and discipline to navigate whatever comes next. And that determination has value far beyond any single investment decision. Think carefully, act deliberately, and never let short-term market noise distract you from long-term financial strategy. Thank you for watching.